podcast is brought to you by Horizon's Resolve Adaptive Asset Allocation ETF, which trades on the Toronto Stock Exchange under the ticker symbol HRAA and is sub-advised by Resolve Asset Management. HRAA is an alternative fund whose investment objective is to seek long-term capital appreciation by investing, directly or indirectly, in major global asset classes, including, but not limited to, equity indices, fixed income indices, interest rates, commodities, and currencies. HRAA gains exposure to these asset classes by investing in derivative instruments that may include future contracts and forward agreements and securities. HRAA will take long or short positions, using up to a maximum of 3 times leverage in asset classes such as equity indices and fixed income asset classes, commodities, currencies, volatility indices, and other alternative asset classes. To learn more about this, please visit www.horizonsetfs.com/HRAA to read about the ETF's investment objectives and important disclaimers about the risks associated with an investment in the ETF.
There you go, man. That's Bloomberg quality right there. Am I right?
Yeah, that song is growing on me. How about you, Adam? I'm liking it more and more each time.
It made me very uncomfortable, but it is a little bit better. Eric, welcome. Ladies and gentlemen, those who are joining us, we have none other than Eric Balchunas. Put your hands together and welcome to the stage, the lovely Eric Balchunas. Eric, welcome.
Thank you. I'm going to pretend I'm in an actual physical location with you guys, and there's a couple golf claps. So, yeah.
That sounds like a great idea. Absolutely. That's a good visual right there.
Guys, so it's nice to talk to you.
Yeah, you too.
Yeah, thanks for joining us. And just before we get started, I should just say that the podcast is for entertainment and informational purposes only. No investment advice this year, at least not yet.
I love how when Mike's not here, you took over the compliance role, right? I think
it's not going to be you or Rod, so it might as well be me.
Is Mike not going to be on?
Mike's not on. No, he had another thing that he had.
Was he fishing again? I wanted to bring up deep sea fishing because I'm really into it.
We can all absolutely chat about that. Having been out.
You go. I know you're in the Cayman now, right?
Yeah.
Have you been since you got down there?
Yeah. I went out 2 weeks ago, 5 a.m., caught the sunset at a 12-mile bank, roped a wahoo within the first 5 minutes we hit. And then we kind of dragged around for a while. We hooked what was it? Something that you couldn't eat. I forget. Anyways, or a barra. And 2 hours later, and then we dragged around, and then we tried to jig some tuna and didn't catch anything. But it was still a fantastic experience. Where have you been fishing?
So my dad lives on the Gulf Coast in Florida, right on the Panhandle.
Yeah. And
so it's Gulf fishing, and lately we've been fishing all in the surf, and you catch smaller stuff. But when he was a little younger, and I would go down there in the late 90s and early 2000s, he was really into it, and he knew a guy who went deep, and I went a bunch of times. And we caught everything from the real dolphin, which is, I think, mahi-mahi, some people call it, but that kind of dolphin, red snapper, grouper, which is so delicious.
Yeah, right.
Shark, tuna, really everything. I mean, nothing was off limits. And the guy was relentless. He just wanted to catch. What happened, my dad got old, and then they also have limits more in Florida now for catching fish. So it's not me. I caught a nice little right time there. That was a fishing village. And also that area's gotten so popular. There's people everywhere. And so it was nice to catch that. It was really
What
awesome.
town was that? Because we used to vacation there twice a year down near Sarasota, but you were further up, I guess.
Yeah, I'm not sure where Sarasota is in relation to him, but he's in Destin or Miramar Beach, Panama City.
Yeah.
That's where they do the MTV spring break sometimes for the SEC conference.
Yeah,
it's basically like the Jersey Shore for the SEC conference.
That's the perfect analog.
There's a lot of Alabama, LSU, Florida State, all that.
Yeah, so those would have been absolutely rocking parties, man. Totally. Which we probably shouldn't get into as married men. So just so everyone knows, I'm sure Eric's face is a lot more familiar than our own, but Eric is senior ETF strategist at Bloomberg and can obviously talk about more than just ETFs. For example, deep sea fishing, obviously. So we're gonna go all over the place today. But so you're in New York, right? And so New York is wide open. You're able to go out for dinner and stuff, and restaurants are open. And how's that work?
So I'm in Philly, which is
so that makes okay. So go ahead.
They call it the sixth borough. That's how big New York is. But no, I'm in Philly. It's I'm going out to dinner tonight. I think it's 25 or 40% capacity. I'm not keeping up with it, but we are dining indoors tonight. And we're somewhat liberal with it, but they closed restaurants for a bunch of months here. But people are starting to go out a lot more now, I think. But in general, you can go out, walk around, jogging, just wear a mask. And, it's been, I think, like everywhere else. I don't think Philly's been that much different. At the beginning, I think there was some Philly like, hey, I'm not wearing a mask. We definitely are a little more like rebellious down here with rules. But everybody adjusted, especially after that second wave hit. Yeah,
for sure. I think in America's been a little bit more freewheeling about it than, for example, all of our team members in Canada are basically in lockdown right now and haven't left the house other than to sort of walk in the woods for 2 weeks and maybe go grocery shopping. So it's
about right.
Definitely different mindset.
My friend, my roommate from college, who was one of my best friends, still is in Toronto, and I make it up there. I don't know, a couple times a year, or used to, for presentations. Happening ETF scene up there.
Oh yeah. Well, hey, man, we're the progenitors of the ETF concept, as you know, and
basketball.
Yeah, that's right.
Oh, okay, wait. So when I go to Toronto now, you know how the Raptors beat the Sixers, which in that game,
in the first game.
Yeah. It was probably one of the greatest endings ever. So congratulations, but it hurt so bad, especially because I thought we had the momentum. Anyway, when you go to the Toronto airport and you're about to fly back to Philly, I don't know if they did this on purpose, but in that terminal, they have this huge mural of the shot, right? But the ball's only like a little bit off his hand, so I went up, took a picture, blocking the ball. And now I open my presentations with that in Toronto, and I've been booed.
That is brilliant. That is brilliant. Yeah, and you don't even need to say what shot it was. Like, that was the shot that rang around the world. Like, that was absolutely magnificent.
Kawhi. But we should be able to take it with a little bit of more sportsmanship, given that we actually won the championship. So you should be able to block it in your own fantasy world.
Canada's just good-natured booing. There's never any negative energy booing. It's all just like,
probably
it's only the Americans doing the block shot move. I don't know what's going on. Can you guys hear me okay? Are my levels okay just before I blow anybody's eardrums off?
It's pretty good.
It's way better. Yeah.
Okay, good. I need to
You're in good shape. So what are the hot topics in the ETF space right now? I guess Ark continues to just blow the doors off. We saw the first major outflows this week, I guess, as part of this market sort of mini reset type action we're seeing. Has there been a lot of chatter about that? You have any interesting takes on that?
Yeah, I mean, for us, if something punches above its weight or defies multiple odds, we give it attention. We gave Jets, the airline ETF, a lot of attention for that. And most of the flows go to boring, Vanguard. Like VTI takes in as much in a year as like Ark has in all assets ever. It's so we try to cover that, but you can only say so much. Okay, it's cheap beta, So we do give outside attention to stuff that sort of emerges. And we were covering Ark early on. I remember I went back and looked. We covered them in like 2015, like 3 or 4 months after they came out, because they immediately topped the leaderboard. And we thought they were interesting because they went across sectors. And it's obvious in retrospect, but the idea of focusing on a theme that could just be active and they could just hop wherever they want. I was like, they're kind of onto something, because at the time these companies were starting to be. Is Amazon, consumer discretionary? What are these companies? They're becoming so big and hard to define that it was actually a logical thesis. But she actually caught a wave, and the wave, she caught it great. I mean, she caught talk about fishing. I mean, she hooked this particular market, and so the asset flows were minimal for 4 years. It's also a lesson in patience. I mean, this is not an overnight success story. I remember watching a VH1 Behind the Music on No Doubt. Remember that band?
Yeah, of course.
Yeah.
I'm Just a Girl. And in my mind, I thought they were like put together by a corporation and made famous like 2 days later. But they were a band for 12 years or something. And I remember that VH1 series taught me that a lot, that a lot of these bands that maybe seem like one-hit wonders, they actually have been a band for a long time. Not
Black
all.
Keys is another one.
Oh, yeah.
That had like 8 records before that.
Yes.
I thought I was like deep underground. And then when they went pop, I remember seeing them in concert at Small Venue in Toronto and realizing as their song was going #1 that was possibly the last time they were going to be in that small venue.
Yeah, that's a good time to catch a band, I think. I actually met my wife at a Black Keys concert. It was our first date, I should say. And I remember her ringtone was James Blunt's "You're Beautiful" in line to get in with all these like hipsters with like hoodies on. I'm like, oh man, they're going to throw us out. And I was like, this date's probably not going to go well. Ended up getting married, so you never know. But we had a good time. It was a good show.
It really didn't go well, I guess. Is that
right? we had a similar one with my wife. We went to a concert when we were first starting to get together, and it was a Mos Def concert, and Drake opened up for him before Drake was anything. And so it was just me and her, and then, a bunch of like hardcore hip hop people. And my wife's like, "Oh my God, is that Jimmy from Degrassi? That's wheelchair Jimmy from Degrassi." And I'm like, "Babe, please be quiet. This is like an up and coming artist. Yeah. He's a rapper now. You can't call him wheelchair Jimmy from Degrassi. Can we please?" Anyway, I cut you off. So yes, the idea of being a 10-year overnight success is kind of what we saw with Ark. Right.
Yeah. And then it happens with hedge funds sometimes too, where they're just out there trying and trying and trying. And all of a sudden the fish start jumping in the boat, and you hit this Malcolm Gladwell tipping point, and she hit it. And she made Jets look like a minor thing in the level of assets. At one point, she's taking in as much as BlackRock. This year, her and BlackRock are tied. And so this is just a phenomenon. And the reason it's even extra interesting is because it almost seems like you're watching someone on a high wire, because this is a very high level she's at. But with the performance and the flows, she has a long way to go down. And obviously that you can't take your eyes off it. So as a story, there's all different angles to cover. And it's, I would argue, probably the biggest story or thing to cover in the last couple of years. And I remember writing about her back like 2-3 years ago. I wouldn't get much readership on the Ark stories. Now it blows up. You get a lot of, and that's why you're seeing more coverage. So those feed off each other.
And with an open-ended ETF, I mean, your options are limited in order to try to manage the flow, right? If you have a hedge fund, you can say, okay, listen, we're not going to take any more assets in. We're going to close it down for now.
The model
you have
doesn't
a bit
work,
more obscurity.
Dude. The whole model works because they can take flows based on performance, right? So it's like this. It's the perfect accelerating feedback phenomenon, right? Small companies, large proportion of the float, huge flows relative to the size of the proportional ownership, driving prices higher at an accelerating rate. Like it's absolutely the perfect story that encapsulates this entire period in markets.
Yeah, well, in her defense, I will say this though: she didn't ask for these flows, and she was doing the same thing for 4 years. I think if you, in her heart of heart, she'd probably want to be like a $10 billion fund, and probably there's no way you'd expect to be this famous or popular or big. And I think that the flow story is fascinating, and it's potentially a problem she's going to have to deal with. And it's also obviously helped her a little. There's a tailwind to
massively,
the flows.
For sure.
Yeah. But some guy on Twitter today was like, it almost seems like he's accusing her of buying stuff just because the flows will make it go up. And I don't believe that. I think she just buys stuff she really believes in. I think she's in the right place. The flow story is out of her control, but something you have to be. Now it's a new variable you have to consider if you're investing with her, for sure.
The new revenues that are going into her pocket must feel nice, but she must be terrified right now. I mean, like you said, it's a high wire act, right? What do you do? You own large positions in very small companies, and everybody knows what you're doing because it's a fully transparent ETF, right? I wonder if she could convert it into an active ETF to kind of give herself a little bit more room to maneuver before everybody else knows what's going on.
I guess she could. We had her on the podcast before she blew up a couple times, and she kept saying like, I want to be transparent, and this is my blueprint. I don't want to hide my holdings. And she did, but it wasn't done so people would copy her and lift the prices of the stocks. Like there wasn't a calculating hedge fund mindset in her, in my opinion. It was very innocent in all of what she was doing. In retrospect, you could see that if you had that mindset, this is a good idea. But I don't think that was her mindset per se, and that's why I tend to try to defend her a little bit. But there's no denying some of these issues are now popping up with capacity. But I think a sell-off is probably going to handle all this. I think that last time I talked to her on the phone, I interviewed her for this book I'm working on, and she was like, well, I could tell she was almost like, we'll have a big correction. Yeah, we're going to get smacked around, and some of these late coming performance chasers will leave. And I do think that her fund probably has a core base of maybe 5 or 6 billion true believers who will buy dips, which I don't think she'll have a complete meltdown. I think you'll have a base, but I think there's probably half of the flows are people coming in because it went up. And it's interesting. Remember when GameStop had that just dramatic increase? For a week, not the second.
Never heard of it.
Yeah, the GameStop won. Her flows stopped completely on a dime. It was very weird to me. And I know
that's a really interesting observation. Yeah,
growth stocks were hit because GameStop almost acted like the VIX a little bit, and so that's part of it. But I honestly think that there was a shinier object in the universe for a week there, and that's how fickle I think there's a layer of flows around her. And so I almost think she would be fine with those being shaken out in a drawdown. So I don't think that's what I think she would say. Instead of moving to a new structure, let's just let the market handle this. And she'll go back to her 5-year time horizons, and she'll say the stocks she picks are supposed to grow and that all these new issues are coming out, which will help bring more options for public markets. But yeah, I'm sure there is some degree of frustration that she has to deal with this other variable now.
Well, I just saw a chart about how when you look at VWAP-based flows, that at $78 for the Ark Q ETF, 50% of people that own the fund will be underwater, right? So basically meaning that most of the flows, most of the people in the fund now got hit the peak.
I think it was MGI Global. I think I may have gotten this slightly wrong, but remember Bill Miller? Right. Back in 2007, he was sort of the mutual fund manager of the decade, and he compounded at 18% a year. And I know Ark's been like some obscene multiple
60.
of that. Yeah. Per
annually.
year. Which I think is just
for how many years?
5.
Ark's done this 5-6 years.
6. I think that's just more that the time and the liquidity environment and managing a public vehicle, like transparent vehicle, has kind of amplified some of that. But anyways, notwithstanding my own opinions, I just think this so rings of the Bill Miller story. I remember everybody wanted an MGI Global, and fully half of their flows came in 2007. And so even though the fund compounded at 18% a year for like 15 years or something, the average investor had negative performance because, just the vast majority of the flows came in at the end, right? And it's one of these things we talk about all the time. Like, what is the mission? Is the mission to get the maximum peak AUM? And I'm not sure. By the way, I'm not disparaging Cathie. I don't know Cathie. I haven't followed the story at all. I'm more just sort of interested in the general strategy of it all. But like, the challenge with these types of stories or phenomena where you get this just incredible streak, you just catch a wave, and I'm sure there's some skill and there's some strategy involved there, whatever. But whatever happens, you catch a wave, and your performance is just so strong that you attract this massive amount of attention, massive amount of flows, and it inevitably means that so much of your AUM comes in late. And you just can't grow at 60% a year, or you'll own the market in like 10 years, right? So like that's an unsustainable growth rate. So reversion to the mean is really going to hurt the vast majority of the AUM in that fund. And there's
it's also interesting. She's launching. Sorry, go ahead, Eric.
Well, let me just say 2 things on that. One is, you're right. History is littered with these hotshot superstars. In Bogle's last book, or was it Clash of the Cultures? It was one of the two. He goes through like 10 funds that were exactly like this. Janus 20, even Fidelity. And, they had their run and then they left. And the thing is, though, all those funds carry on. They still got a couple, billions in dollars. Mm-hmm. So if they start out here and they have this huge rush, and they do end up ahead of where they were, and they are managing money. And in a lot of cases, like Janus's, after the drawdown, and then you look at the hold, they did well. The question is, we know people aren't going to handle that act 2 where it's a drawdown, and that's ultimately a behavioral issue, and why quants will always be in business because people just chase shiny objects. It's just like human nature. It also reminds me of DXJ. Remember the currency hedged ETF?
Oh God, yeah, for Japan, yeah, totally.
Remember that was a whole craze. I mean, it spawned iShares had a whole suite of it. Like everybody who had currency hedged, they started doing currency hedge minimum vol. Like they were combining like fads together, And the whole thing had maybe 60, 70 billion. I think it might be down to 15 now, like DXJ's 1.5 billion. That said, 1.5 billion for something like a currency hedge Japan isn't that bad. It's just that it had like 18 billion at one point. And I don't think Wisdom Tree meant harm either. And I think Cathie's just like, I remember she pitched to Lyons Bernstein that she wanted to just do a concentrated fund with just the best innovative companies that she could find. And they said no, maybe for the reasons that you're mentioning, but ultimately she could finally do it over here. But I don't think it was malicious, but certainly if you are going that direction, you almost like you should have a warning label that this could go really well or really bad. It's basically home run swinging. It's like Babe Ruth style active.
Yeah, but I don't. Again, I don't want to imply any nefarious intent for Cathie. I think part of it's right place, right time. Part of it's, I'm sure there's some skill and strategy there as well. I do also want to credit Vixologist who corrected me. It was Ken Hebner, CGM focused, not Bill Miller. So yeah, sorry, brain fart there. Totally right. I think there
CGM,
is.
Oh, you're talking about the CGM focus?
Yeah, CGM focus fund. Exactly.
This is the it's very good of you to pick on. We actually did a note where we looked at this one, and the similarities are eerie. It literally the 900% markup, same exact thing. But then it went down, and it got like 8 billion at the peak. Then it went down 50% in 2008, so more than the market, and it lost half of those assets. But then it lost the rest over the years.
Yeah, right.
I don't know, 400 million today, but lifetime it's beaten the market.
Right, yeah, but not for the.
I mean, he did his job. He just took like the hare instead of the tortoise route, I guess.
This is the time weighted returns versus the dollar weighted returns, right? Of funds, and I mean, it's just such a perfect fable lesson, right, for investors, right? Like the historical performance that you see is not the performance you're going to get because your performance is path dependent upon when you enter, right? And so just shifting gears a little bit, I'm just wondering whether you think the structure, like the choice that Cathie made, whether it was intentional or not, to remain this sort of transparent vehicle rather than taking advantage of some of the obfuscation that is available under the sort of active ETF structure. How do you think that has either intentionally or unintentionally contributed to the effect she's had, the halo effect, the attention, and obviously the performance?
It's a good question. And I mean, the big variable is probably not realizing your growth would be that parabolic when you set out on these plans. But again, before the growth, she just thought the ETF was a disruptive vehicle itself. And she's all about disruption, so it fit her mindset, first of all. And she was well aware that this was where most of the flows were going and whatnot. And I think she felt that she wanted to be on that side, that growth area, product-wise. The idea that she would show her holdings, she had no problem with that. I remember she was like, I don't care. And she also, I think, was it something like, if people know, she just was fine with that. I don't know if she thought of it in the terms of like, oh, you can follow me now. And like, because there is some degree of like, and marketing where it's like, you can get into my world and follow what I do. I don't know if that was exactly her goal. I don't recall her saying that specifically, but it certainly helped build an ecosystem around her. Yeah. Because now you can like, okay, why'd she buy this? I know now it's a flow issue and it arguably is much more technical, but at the beginning, I think people just got into her thing. They could follow her trades. Oh, why is she buying this? They could ask her questions. She has the summit every year. And we thought that was a decent blueprint for active. The flow issue complicates it a little. So
she did it too well.
Yeah, and the active non-transparent ETFs are coming out. They almost seem, the problem with not showing your holdings is fine, and it probably would help them if they hit a home run. But I just don't think they're going to get many bites doing something that's like low tracking error, but like a high fee. I think that's a middle ground that's just not seeing a lot of action. I think most of the flows go to literal beta for like nothing, or something that just moves a lot. And I guess maybe investors are like, I got the beta covered. Let me put some hot sauce on the plate here. And I'll have fun with this, and it will take my mind off the boring part of the 80% with all the cheap beta. And potentially that's made the middle a tougher. It's barbelled. it
Right,
seems
that makes sense.
Flow
Would
show
you be
that.
able to kind of keep most of the holdings under these new rules public, but then keep, I don't know, 10 to 20% of it sort of hidden, shrouded in a way that she could then hedge part of it? I mean, she would still accomplish a large portion of what you're describing was her original motivation, but then also kind of protect against some of the beta, because this thing has gotten much bigger than than her. I mean,
Or
it's
delayed.
part of this,
Like delay the
right?
transactions of it.
Yeah. Well, she's in a transparent structure. I don't. The one thing she can do, I believe she can do cash in lieu. If there's some stock that's just you does not want to pump money into, she can accept cash, so they don't have to go buy it, and then she can deploy that cash how she wants. Being active helps a little. If she was passive, like the way the S&P rebalanced into Tesla and everybody knew it, I mean, that lost a lot of money for index investment. I mean, that was just a so obvious front-running trade right there, and it worked easily because the index is like dumb. It has to do it. She can like make decisions, and we have noticed she's putting more big cap names like Lockheed Martin and Google in where they're like almost like the way a high yield manager would use HYG. They keep beta to that theme, but then they're cash management facilitators, and so she could do that. But that would ultimately make her active share lower to the S&P, drift her up into large caps, and maybe take a little of her edge off. So that would probably be the price she'll have to pay over the next couple of years if nothing calms down. She'll probably have to just start finding good large caps.
Yeah, what's crazy is that she's created her own gravitational pull, even with the obscurity. She announces that she's going to do a space-oriented ETF, and the big space names are up 10% that day, right?
That's crazy.
She's already getting front-run by simply announcing that there's going to be another product coming out.
That was when we knew this was rock star level. I mean, only Buffett can do that. Like maybe Gunlock a little bit. Sometimes Gunlock would give his picks, and we'd see a bump in that. He goes buy EM and short SPY, and we'd see flows in EM. I mean, there's only 5 people, maybe.
Well, don't forget deep fucking
Elon.
Elon. Well, Elon's the ultimate. I mean, he's like literally God over the market. I don't know who has more power, Powell or Elon. It's close, right?
It depends on the day. Yeah.
I think in terms of like day-to-day, dispersion within the market, I think Keith McCullough has the box at the moment on.
Is he? You think he's actually?
It's just unbelievable. Like I talk to all these people who are
really,
sort of just getting into markets the last 2 or 3 years, and just worship the altar of head giant Keith McCullough. Man,
I mean, I know who he is, and like in a way, he kind of has the same vibe as Cathie, and he's open to here's what we're thinking and bringing people into the universe. There's people who want to have fun, they want to gamble, and they want to get into trading, and they're almost like gurus that are able to bring in a cult following to a degree.
He gives them the framework, right? I mean, at the end of the day, that's what people who want to be in this market, which kind of begs the question, and I wanted to kind of ask you, you're definitely seeing a lot of flows and the hype, but did you overlay that to some degree with kind of like a top-down macro framework in order to kind of get your picks as you think about the space? Obviously, the flows are a big portion of it, but do you pair that to some degree with a global view?
Are you asking me just my general global view of the markets, or if the flows are telling us that people are doing more top-down investing instead of bottom-up?
Well, I think the former, but however you want to take it, you can take it in both directions if you want.
Yeah, I mean, I'm one of these people who would have thought the market would have corrected like 100% ago. And so then now I just don't even stop thinking about it.
You're with your people, dude.
Yeah.
Yes.
I mean, that's the thing with all these pushbacks, and even the Ark people were doing football spike because they had a day of outflows. I'm like, listen, anybody who's tried to spike the football too early on anything that's bearish has just looked like an idiot. So I just take it, deep breath. As long as it seems to me, as long as the market thinks the Fed is got its back, these things are usually short hiccups. It's almost like the Fed is one giant painkiller. And so you don't feel much. And that's the big thing for me. I just think is if you had, I don't know, if Powell was replaced, then you got a more hawkish Fed. That to me, that's when this sort of you lose the medicine. And I think that some interesting things could happen. I honestly, because I polled people, like, do you think that the March sell-off, and I'd like to hear your guys' question on this. In March, the market went down, what was it, like
25%?
35, right?
35, yeah.
Yeah. Now, let's just say that the Fed did not act. It just said, you know what, you're on your own. Now, since March, the S&P is up. I'll tell you the answer. And then you tell me what you think it would be up had the Fed done nothing.
I think we'd be eating dog food, or all sort of farming our own vegetables and trying to catch chickens and stuff for food.
Jesus
So it's up
Christ,
73%.
Butler.
Yeah, Adam. There now.
Oh my God. All right. Well, I have a different answer than that.
There was no bid, dude. There's no bid other than the Fed under this market.
This is where the value guys would have replaced the Fed.
There's no value guys left. There's zero AUM in value. Period.
Are you kidding me? Most investors are disgruntled value investors that have been pounded to the pavement. The vast majority of investors are continuing to be value. At the margin, you have like
improves.
You're out of your mind. No, there would have been a bid. It just wouldn't have been
From
a
who?
V recovery in the same way.
No,
Well,
there was a global collateral
part.
call, dude. If there's nobody out there to provide collateral, then there was a global collateral call. The entire market would have been dictated by margin calls, and this is the Mike Green thesis playing out in real time. Without a backstop, we are so massively under collateralized as a system that if there's a global collateral call and there isn't somebody there to provide, last mile liquidity, then this whole thing goes to zero.
The Fed didn't come in. The banks, there's always a backstop. It just may not have been the Fed. It might have been an 80% drop. But, dog food and whatever else you said is a little pessimistic even for you, my friend.
Rod, you weren't here for the we actually said this is for entertainment purposes as well. I think Adam's just taking that to heart. He didn't mean it. Just let's move on. But I think it's interesting.
He means it deep in his soul.
My assertion, dude.
I can see the Fed is a this happens when I talk to people. I'll have one smart person say, no, this is just markets, Fed or no Fed, this would have happened. And then I'll have someone else go, no, absolutely. And the one thing I would say is I think people are discounting putting a floor on that particular moment in time, because I remember active mutual funds, especially on the fixed income side, had just seen $90 billion in a week. And PIMCO income fund was down 12% in like half a month or something. And at some point, you saw the ETF discounts. There was no liquidity. These funds were going to have to unload bonds to who? And then they were going to have to halt redemptions. And then there would have been a run on mutual funds. That's the downward spiral I think the Fed stopped. And ultimately, I'm more on the dog food side. But I certainly don't think it would be up 73%. I think at some point after the dog food was served, natural bids would have come in. But I still think we'd be down like 30% or something. That's my
100%. That's a reasonable answer. You'd be eating dog food because you're depressed, but you can still afford the dog food. Right?
But by the way, the Mike Green scenario,
by necessity,
your portfolio will have some value.
Mike Green and I were, I talk to him all the time. We used to, I love talking to him. I know what you're saying. My different on Mike Green scenario is that what I saw in March was that the problem's going to come from active mutual funds, because that's the demographic that's going to bail the soonest. So they're going to be the sellers. If anything, passive could provide a backstop, because all those people do is keep investing. They're taught to just keep buying. And if anything, they could put some floor on the bottom. It's in 30 years after all the active funds go away and there's just passive that I think Mike Green's scenario will come through, where all the Vanguard investors leave, and it'd be me at 65. But I don't think we got to get through the active mutual funds first, in my opinion. And we saw that in March. Passive saw inflows. Active had 500
I don't know, it
billion.
depends on the active manager, right? Like, again,
I
go back to value. Value guys are buying. Value guys are buying. So there might be a period by which.
It depends. If that active value mutual fund saw inflows, sure. But the net outflows of active mutual funds was $350 billion during that 3-week period. That is a lot of money.
Oh, I'm not talking about a value factor fund. I'm talking about actual, legitimate guys that have been sitting on cash for a decade.
I think Eric's talking about the liability of those funds. So I think his thesis is more the generational, the boomers who are the
boomers are 60, funds. 70. They're not going to.
Yeah.
If that market were to unwind more, they're like, I got to get out of here.
Sure.
And so they don't have the time on their side. And I don't think their loyalty to active mutual funds was that high in addition. The people who got into Vanguard sought out Vanguard, or these RIAs who saw the light. and they're much better behaved. We see it every sell-off. So I just think those people need another 30 years to become old and want to get out before it's too late. I just think active mutual funds are going to be the first wave of the sort of liquidity problem that is spoken about. I don't think Vanguard I just think they're very disciplined. They're taught to keep buying, and they're also younger. And that that matters. So it's not the value guys and whether they buy value stocks. It's more their investors and whether they stay in the fund or not. Because in a sell-off like March, value is down too, right? So you might have just too much outflow pullage to really do much.
The challenge is in a world. I'm going to just come right in over the top. The challenge is in a world like this with such low rates and everybody looking to every dark corner of the markets to generate some sort of excess return or some sort of spread on yields, that there's orders of magnitude more leverage in the system than anybody would care to admit. And I hear you saying that the boomers behaviorally and probably for rational reasons, given that the duration on their liabilities is low and shrinking, that at the margin that they will also end up being a net seller at a certain point, just to like preserve their way of life. But I think in these acute crisis scenarios, it's less the sort of typical investor making quasi-rational or even emotional decisions about their wealth, and it's more to structural leverage in the system that needs to be unwound
that's different
market neutral in CTAs in risk parity in wherever the leverage exists in structured credit. There's such a massive amount of credit in the system that needs to be that's essentially VAR managed and needs to be all unwound at the same time. And that is the dynamic that the Fed, it's a bank run on the global collateral system, and the Fed steps in to be the provider of collateral of last resort. And if the Fed doesn't step in those situations, the 7% discount to NAV that we observed in TLT on February 24th or whatever it was, would have grown to 30% or 80% or something, just because there's literally no buyers. There's no one's accepting repo. No one's accepting collateral from on the run treasuries. There's literally no one with any collateral left to borrow to buy.
I can just see Warren Buffett backing up the truck.
He does have
I
80
agree.
billion in cash or something.
I think it's degrees, right? So I agree that it would have been much, much worse. I don't think we go to zero. And I also think we're in fantasy land. The Fed will always step in. And now, I mean, we saw how quickly they stepped in contrast to 2008. So they have their guns ablazing, man. They're going to keep on doing this every single time.
I sometimes think, though, what if Ron Paul's son, Rand Paul, Ron Paul was like, I got to get rid of the Fed. Like, he had a decent following. Like, he could have been, if one of these guys, I mean, I don't think Bernie was too hot on the Fed. If one of these guys gets in that's like major populist, then he feels like the Fed just enriched all the rich people. He could just install a hawkish Fed governor. Sure. I think that's the black swan event that would change your situation.
I had my 8-year-old was wearing "End the Fed" T-shirts.
Your 8-year-old
in 2010.
Was this from osmosis, or did you actually
five, I guess,
iron them in? And
no,
everybody has to wear these T-shirts.
You could order "End the Fed" pink "End the Fed" T-shirts for 5-year-olds back in 2010, 2011. It was absolutely fun. I had like all my 5-year-old and my 3-year-old pink and blue, "End the Fed" shirts, walking around in the strollers.
Love you.
The other scenario is the market itself taking the printing press away from the Fed. I mean, at the end of the day, the Fed losing its credibility in backstopping. I mean, to some degree, what we're seeing now is inflation expectations coming up, and people concerned about rates, which is why the curve is steepening. But at one point or another, you might imagine that the other black swan would be just the Fed coming in with this this promise, and the market shrugging at them and saying, you know what, no, we're not playing this game anymore, and moving out into other areas of the market, Europe, emerging markets, like not wanting to touch U.S. sovereigns.
Yeah, I mean, remember in March, the Fed did a couple half-hearted attempts, and the market shrugged it off. But then they did what we call kitchen sink day, March 23rd, 2020. We'll live in infamy. And that did it. I guess literally buying ETFs and bonds was like, okay, well, there's a buyer. And look, Japan, I mean, we watched Bank of Japan. They own 75% of all ETFs there. Now, I think that only adds up to about 5 or 6% of the stock market. ETFs are a small fraction of the total stocks. But the fact is, they're just, I think, comfortable living that life. And it's going to go to 6%, 7%. And ultimately, you get to a point where you're kind of like a country like India, where it's socialized. But India is actually divesting and wanting to go more towards the way we were and let animal spirits take over in capitalism. So they're using ETFs to get out of stocks. So it's interesting. Bank of Japan and India are two different paths. I put us in the middle somewhere.
So walk us through the Indian model. What are they doing? So the Bank of India already owns a lot of equities or equity ETFs.
They own a lot of companies in India. And so what they've done, they set up ETFs that the Indian government basically says, if you buy this ETF, we're basically the seller of the stocks in it. And so anybody buying the ETF we're just getting rid of the stocks through the ETF. And then the ETF lives on the India exchange for whatever. And it's funny, the ETFs have done pretty well, like because there was a lot of buyers. So the India government, we wrote a piece once about how they were outperforming the market, and it's since changed. And also in the Bank of Japan, there's an interesting one there. And I always think the Fed should do this. If they ever go to buy equities, the Bank of Japan was like, we keep buying these stocks that just do buybacks, which is maybe not we want them to do CapEx, right? So they had iShares, BlackRock design ETFs that tilted towards CapEx and companies that hired. They looked at hiring and capital expenditures, and it's called the Human Capital ETF, and that became a tool in the Bank of Japan's toolkit, which to me would be if a twofer. You lift the equity prices, and you at least get some of that money down to the economy as opposed to the buyback situation.
Fiscal policy via the capital
markets. That's actually really clever. Very interesting. Yeah.
And BlackRock worked with BlackRock is very they're everywhere, man.
They are commercial.
They're not messing around.
No, for sure.
That's an interesting view. So what are you seeing in terms of active ETFs versus passive ETFs in the last year? I always, we've always seen these flows out of active into passive, but now with the new rules, are we seeing a shift in the ratio between those two, especially if there were a bunch of active funds that actually did fairly well during the crash? What are you seeing out there?
Okay, so there's active to passive and there's ETF to mutual fund. And those get confused in the press all the time because somebody like the mutual fund's dead. Well, no, Vanguard has trillions in index mutual funds. Not only that, there's trillions in regular active mutual funds. The market return has been so good. Listen to this stat. This stat blows me away. And active equity mutual funds had 3 trillion 10 years ago. They have 6 trillion today, but they've seen 2.3 trillion of outflows. Think about that. Yeah. Isn't that crazy? What other business does that? Could you lose 80% and still be twice the size? So we consider those mirage assets that will fall, basically tumble very quickly in a bear market. So we think the market share of passive will grow quicker and it'd be expedited. If you took the market return away, passive would be 80% of mutual funds right now. But the market return has been a great buffer. Anyway, in the ETF side, active has done better than it has in the past. We have this chart called the cost obsession barometer, where we track the percentage of flows that are going into products that charge less than 20 basis points. That means cheap beta. It got up to 99% 2 years ago in 2019. It's now been slashed down. I think last I checked, it was 70%. The shiny object lane is grown big. That's Cathie, that's themes, that's ESG, and that's true active. There's been but the middle of the road active, like the Davises and the Ants, the active non-transparents, they haven't really done much. I mean, all active non-transparents combined, there's probably 15 of them now and they're a year old, have about $1 billion. And I would say probably only 300 million of that is true organic flow. So 300 million, Ark would do that in an afternoon. That's how little traction the middle has gotten, and why we our theme is bifurcation, barbelling. And so when you say active, I would say that there's active, and we consider it like new active, which is like what quants do, rules-based smart beta, right? So it's active, but you're using an index. And then there's things like ESG, to me, is active. And then themes are very active. And it's interesting, my colleague, and I'd love to get your opinion on this, my colleague Tom wrote a note looking at how, like, when it comes to value, investors are like, okay, I get value, I'm going to buy a value fund. But momentum, for whatever reason, retail investors just, I don't know if they don't understand it or the word's too scary, but what they will buy, they'll buy funds doing momentum, but they won't necessarily buy momentum funds. So like, we think that themes in particular have come around and really just stolen the thunder from a part of the quant world, namely momentum.
I see what you mean.
Close to a little bit. And so it's an interesting battle within the active lane between all these different things that, and the labels they put on it, but a lot of it's just growth and momentum by different names. And it's interesting to us. And I think it could probably frustrating to the rooted academic momentum that is rooted in all this evidence. And then you got this theme ETF comes along that does like, whatever. And, future tech.
Well,
and
look, man,
$1 billion.
this is my point. Everybody's a closet value investor. They can't even admit it when they're buying momentum, right? Everybody wants to feel like they're buying a deep value company that's actually making a difference and creating something real, like Tesla, right? Like that is for a lot of people a deep value play that misunderstood deep value play, and they'll never call it a momentum strategy, right? We used to be asked to pitch the University of Toronto fund years ago. And we did a lot of momentum stuff back then. And they just, the quant team was like, this is amazing. This is like really solid work. It makes sense. We are never going to be able to invest this because the board is
an ex-investment banker, and there's no way he's going to invest.
No way. He needs to understand.
Sort of momentum strategy. Yeah.
So
momentum
it's in our nature.
I mean, momentum's done very well. A lot of the funds are up 40, 50%. Now, Cathie doubling that return makes it that it's taking a lot of the attention away. But there's theme ETFs that are up, consistent with momentum, and some of them overlap really well. I mean, you can tell they're. And now I think what's going to happen is instead, if value comes back, watch the theme people try to steal that thunder too. I just saw filing for airlines, cruises, and hotels, and that's value, right? So you can see people put like names on what would be value, and so there's this interesting coming collision between quants and themes, I think. That's one. But then traditional and that's going to be more for things that can outperform and you'd put on top of your cheap beta. And then there's traditional stock picking, which is a very tough world. I'm not sure there's much going on there beyond if you're going to do Babe Ruth and go swing for the fences. That said, there's so much assets that you're not hurting at all. I mean, you're very comfortable, like the $6 trillion. So that's why I think you've seen much more griping or either like layoffs from that side of the world, because their revenue and assets are almost as high as they've ever been. But they have organic growth problems. And so you probably see a lot of consolidation over there. But the innovation and the flows are going to go to some of the stuff we just talked about. But that theme, quant versus theme, and I put Cathie in there in themes.
I agree.
Those are going to battle over some of the assets from advisors and retail. I think institutions, are knowledgeable enough to know that's just labels and go for the academic stuff. I don't know. You guys have any opinion on that?
Our observation typically is that the institutions are not always that different in their decision-making process from many of the more experienced retail investors. So I'm not sure. We used to think that we could have a clear separation, and it's blurred over the years. We've got some really sophisticated individual investors and family offices that challenge us in really cool ways and make us better, and institutions that end up really just being herding and more concerned with peer review than any sort of innovation. And it's I think that designation is kind of blurry, but the whole theme thing fascinates me beyond all
it's closet
rationale.
momentum, right? Because whatever's working loads on momentum, right? Momentum is the
But the
underlying.
theme creates the momentum.
Well,
right, exactly.
let me
it's
posit
narrative
something.
based.
Let me connect the dots there, because I think it's like I believe something, like something. I have a bias, and then my bias starts to work, and then you're like, oh my God, this bias is absolutely.
It's a self-fulfilling
you don't
prophecy.
think it's a bias. You think it's like this is the way the world works, or this is like a manifestation of God's values. And you're like, okay, yes, this is exactly the way things go. And the capital starts to flow there. You're like, oh yes, this is, and so you're all in on this theme, right? And it's the momentum guys are like, yeah, we actually don't have any stories, and we don't care about themes, and we don't whatever, but we love that you care about themes, because that's how we're going to
drive these inefficiencies.
Exactly. We're going
to. Because Ryan Curlin was like, we should start advertising like we're whatever theme is working. Like we're a greatest hits of themes. Like we're just going to theme for you. And I know he's joking, but there is something to communicating in a new way about what momentum is. I think momentum, in particular, I do, a lot of these TV hits, and I talk to analysts, and even people inside like the financial bubble get confused with momentum, and it's almost counterproductive because you think performance chasing is bad, but here it's good, and trend following is in the same boat. But I think that's, for some reason, value is so much more easy to lock into for people.
It's because it's based on balance sheet data, right? It's not.
Yeah.
It's the most
momentum is
intuitive
purely.
factor.
Wait. You're telling me your process is to look at price, and as price changes, you do more of the thing that it just did. What about the price to earnings and meeting the management and understanding the underlying? No, it doesn't.
Would you walk into a store,
right?
and if and you looked at something, it was $50, and then it went to $60, you'd buy more of it?
Right. Yeah.
It's just so counterintuitive.
Really
Whereas
that's the Colin Roche joke about the market is the only venue out there that
where
people
demand increases as price
rush
increases.
out of the store when there's a 50% off sale.
Yeah.
And they'll keep piling in as prices go up. Yeah, it's
Totally.
really interesting. I think there's like this historical bias that the intelligent investor, like Ben Grant's thesis, is all about, you buy something cheap, you wait for it to converge. So I think that value is the more intuitive of all the factors because it's the easiest one for you to get behind. Who doesn't want to buy something that's cheaper than it's worth? And at the end of the day,
I buy dollars for 50 cents.
I mean,
exactly.
There's this this ETF with the ticker Dude. It's the sector.
Does the Dude abide?
Yeah. Do you know this guy? The ticker was through Alpha Architect, a white label, but it's the Merlin AI. Anyway, the idea of calling himself a surfer. Again, I think you're going to see a lot of attempts to relabel momentum. And because surfing is somewhat of a decent analogy. You're riding the wave, you're getting off before it hits the shore. And I used to compare it to almost like being a chameleon. And you're just sort of going to go with this crowd, then you're going to bail before they go off the cliff. And I don't know, there's just probably some opening for some interesting communications, I think. But I would say the quants, I think, have a formidable opponent in the theme people.
For sure. I agree. I think that there's never more momentum than the last 15% of a theme move. I mean, Bitcoin is another one that we haven't even started talking about, right?
Oh, yeah.
What's going to happen there? How many ETFs are launching in the U.S. right now? How many are listed?
So nobody has a 19B4 in yet, so there is no technical ones on the clock. That said, there was, I think, 17 filed at one point before the SEC told them all to stop. So to make a long story short, I believe there's probably 15 issuers that are interested in watching and hoping to get out first. I think you got about 15. I equate it to the Cannonball Run, that movie from the 80s where they go from New York to LA, and whoever gets there first gets like $1 million. And they all have little tweaks to how they're going to do it. One's an ambulance, one's like just as priests. Because you can tell from the prospectuses, some will add this, take this away, and some file first, some have better lawyers. They're all trying because whoever's out first, if they approve one, they're going to be rich for life. I mean, the SEC is in the role of kingmaker now. It didn't have to be like this. I think if they approved the Winklevoss and the first couple. The Winklevoss, by the way, they filed in 2013, and Bitcoin was $99. That's how far ahead of the curve they were. And
dude, did we just jump the shark? Let's hashtag crypto here. Like we're now okay. We're here. I was hoping we would get here. Okay, keep going.
Yeah, I mean, so I would say in a year, if the SEC evolves mentally fast enough, which I think they should, you could see 10 Bitcoin ETFs easily. The floodgates will pile open. The question is, do they approve 5 at once to give some level playing field, or they let like one out first? Because whoever they let out first, it's like they're born on third base, and everyone else has to start at home plate. And we saw it in Canada. The one had a 24-hour lead and has like 95% of the assets in volume.
It's crazy. We know the story. We know the principles of the one that came in second, and it's a brutal. Like nobody knew it was coming. It could take a decade.
They
jumped ahead of the line.
It was nice arb opportunity where everyone was selling the closed-end fund and buying the ETF, and so the closed-end fund was trading at like a 15% discount to have.
And the closed-end fund is going to convert into an active ETF, so you could I don't know what it's at now. It probably still has a discount if there's. That's a good trade. This is no trading advice.
Yeah,
that's right.
Yeah.
Let's see what it closed at. I think
only somebody knew how to
11%
what the 11%.
discount.
Yeah.
And it's way more than the fees.
What's the discount?
11%.
11%. So you can get right now. You can buy that. Wait for it to become an open-ended fund. Get NAV. Because you can buy Bitcoin at a discount. It's amazing, and it's because of this purpose, right? Was the fund?
Yeah.
So do you guys know them? You're from Canada. Like, how do they do it?
We know Sam pretty well. Yeah.
We know some stuff.
I bet he's gotten calls
we
from
can't say
half of those issuers that I just mentioned in the Cannonball Run to be like, how'd you do it, dude?
Is Cannonball Run?
Well, let's take that conversation offline.
Burt Reynolds, close.
Oh, Burt Reynolds, exactly, yeah.
And that actually had Dean Martin and Sammy Davis Jr. where they were the priests. Remember that? If you go back and watch it, it's like an 80s comedy, like.
Oh yeah, no, I've seen that one.
Yeah.
Very light but funny. I thought
that's awesome. Yeah.
But look, there's certainly. I mean, Canada is a small market, right? And people think that we're types of people that play by the rules all the time and are very nice. But in the capital market space, if you know the right people, because it's a small community, it's really about relationships. So I wonder if this is a question. We got 5 ETFs applying in the United States. You want to know who I think? I think you put a poll out. And I voted that it's all about relationships. I've seen it happen over and over and over again.
Lawyers and money was a close second, though.
Right.
But that said, if you hire a lawyer who used to work at the SEC,
that's relationships.
That's
ding, ding, ding.
Interaction effect right there. You're conflating two variables. You're offside.
So
I'd be curious to know when that happens, what's going to happen to Bitcoin, right? Because these guys have to come in and buy. It's like Cathie and the space ETF, right? She's not even buying it yet, and it's already popped. How much is going to pop because of the anticipation of the ETFs, and how much is going to pop once the ETFs go live?
Yeah, I think the Canada Bitcoin ETF though came out, and Bitcoin has had a rough week. So we don't like. I used to think if it was back in 2014, Bitcoin would have popped major. But there's a lot else going on. Like Elon could just say it's overvalued that day, and all of a sudden that overwhelms the ETF issue. There could be something else. So Bitcoin's so big now that I don't know if it's a guarantee. It should help overall, though. But this week, Bitcoin's down heavily, and the ETF came out. So I'm not sure. But back to the Ark and the space, I can't tell you how weird that was. Like UFO is this, and I guess Andrew Chanin, he put out Hack. Then he got in a fight with the issuer, and he kind of got a raw deal. So he comes out with UFO, and it doesn't really go anywhere. But he got like this nice sort of gift from God in that our Ark is filing a space ETF. He goes from 30 million to 140 million in like 2 weeks.
Come on.
Just because people want exposure to space in the 3 months before the Ark ETF launches, and it went on a nice performance run. Awesome. And I've never seen a filing that literally made another ETF's career. It's unprecedented. That said, he might see some drain when she launches in April.
How much pause does this kind of price insensitive buying give you? I mean, we're back again to the Mike Green thesis. It seems like he's top of topics a lot of the times.
He's omnipresent, dude.
He's omnipresent, absolutely. But what do you think about it, Eric? No, just this idea of how much of this price insensitive buying that you see from the index tracking, passive vehicles, and what that has done to the market itself. I mean, it is the divorce from fundamentals notion that I think a lot of people are thinking about. But what is the solution at this point, or where are we headed?
So we would say 20% of the market, stock market, is owned by passive mutual funds or ETFs. And then maybe add on another 10% for SMAs that you can't see, maybe another 5% for CITs. So you get to 35%, right? And of that 35%, though, I think only half is like true beta. There's all other weird stuff going on. And there's, like we said, there's a lot of active that's passive, grouped as passive. So it's not all just like one homogenous blob. But there's probably, 15% that's a homogenous blob. And sure, that's the money that drips into Vanguard. But if you removed Vanguard and you put them all into Fidelity's funds, they'd be buying the same stuff. I mean, it's really more the tyranny of the index. The S&P ultimately is dictating it. And this is our theme that we write about sometimes called the beta vortex, which is that it's not necessarily an index fund or passive, but it's just so many things revolve around the S&P now that it sort of sucks in return and money. And then the return makes more money come in. And yeah, I think there is a sort of upward spiral that it creates. That said, the price distortions, I think, are overrated. I think the GameStop is the situation you got to watch for, because if you have a stock that has a low float and it's not big, and you have passive owners are not going to sell GameStop based on what Reddit does. They're not moving. You could have stocks become targeted, but you cannot target Apple this way. There's just too much else going on. So I do think you might have some funny, wacky scenarios with smaller stocks if they decide to target one of those kind of value stocks. The other thing is, if you look at the S&P 500, what we try to remind people is like, companies go in and out of it all the time. Like Tesla got added, but why? Well, because Active bid it up. It only had about 7% passive ownership for a long time. So Active is the reason Tesla's in the S&P. And then you have Macy's getting kicked out of the S&P. Why? Well, Active hates Macy's. So I would say that the passive is in the back seat, and it's following what Active does.
Now, wait, but how much of the thematic, because at the end of the day, you do have some rules-based thematic that we're probably owning Tesla, and that's also back to the momentum narrative sort of thing, and that may have begun, and that becomes a self-fulfilling prophecy that then drives more flows into it. I don't know how big the thematic theme is.
It's too small. See, theme ETFs have like 180 billion, right? The Fidelity Contra Fund is bigger than that.
Yeah,
when you get to the Fidelities and T. Rowe's, the amount of money that they had, that's why I'm trying to remind people of the Ark. Like, yeah, she's got some big ownership in some mid-sized stocks, but Fidelity Contra Fund is 2 whole Arks. I mean, we're talking, there's some whales out there. Nobody really, I don't know. I think it's because they've been around us so long, they're not new. So people just are used to these whales swimming around, and they don't, I don't know. That's why I think the demographic shift of people selling out of those funds is bigger than people. I think that's being underrated. I think what's overrated is the ETF issue, and also the weak hands of index funds. I don't think they're as weak as people think. No, I think they will be a stable force for the next 10 years. But
that stability ends up not to Minsky is too broadly here, but that and I think Dave Nadig kind of triggered this memory for me, or thought, but it's not so much that the index funds are sort of weak hands, or that they aren't as influential, but the reality is every dollar that goes into index funds that are through sort of systematic retirement purchases, for example, and are not like tactical, they're just going to buy in, they're going to hodl these index funds, right? Is basically taking a dollar from the float, and like a cap weighted dollar from the float of these indices, because it's basically like insider ownership. It's like these are shares that will never be sold for any sort of active reason, in the same way that insider shares will never be sold. And so you're systematically removing float
sure.
from all of these companies, right?
I would just say, like again, let's take Vanguard out of the equation and say that in the next month there was no Vanguard or no index funds. You'd have to buy Fidelity Magellan. And what are they buying? They're buying the same exact stocks. Is the Fidelity Magellan taking away float?
Yeah, but I agree. But there would be at least there'd be some variation,
human hand behind it, yeah,
right.
And fair.
And there would and there's some legitimate, at least attempt to deploy capital in its most productive and efficient form, right? Like, there's no attempt at the index level to do that. At
it's
least
fully
Contra Fund's
knee-jerk.
saying,
Yeah, the passive is fully a knee jerk. Just money comes in, I buy.
Passive meaning market cap weighted, which means that if there is
Yeah.
less of a
Trade
float and people at the
Russell
margins are
trades
increasing it. There isn't an active manager saying,
Yes.
"Okay, this is overweight. Maybe I should cut
it's
that
a
off."
computer.
Right?
If big, buy.
Yeah.
Right,
Yeah,
I got it.
exactly.
I mean, this is an issue we're going to live with. We think that I just don't think it's clear and present yet. I think there's enough float. I think we see sell-offs. Look at news, stocks go up and down with sell-offs. And ultimately, the reason the index owns it is because active thought it was good. And the reason the index would not own it is active thinks it sucks. In fact, we have this list of stocks that have the least amount of index ownership. For people who say, oh, there's a passive bubble, I'm like, okay, you want to invest outside of it for when it bursts? Well, these stocks suck. And you know why? Because you know why no passive owns them? It's because active hates them. So
there's a point when active is so large that just by virtue of active needing to own them, it overwhelms the impact that passive needs to own them. It overwhelms the impact that active can have to modulate the price inefficiencies, right? So there's a point at which you cross the chasm, and I'm not sure that we've observed any good models that describe when that is, right?
I mean, again, we look at each sell-off. We look at March. There were some stocks that went up and down, but there were some, obviously the whole market went down if you look at an index. But in there was definitely some dispersion. Again, the rise and fall of stocks within an index, to me, as long as that keeps happening, I'm comfortable with it. And this is something I brought up on a podcast I did with Mike Green, which is that even if you think this is an issue, there's a lot of people, even if they were like, you have a good point, market structure could be a little tested here by all this passive, and that person's in passive funds, they're not selling. They are not going to take one for the team and go buy an active mutual fund at 1% because they know they're going to lose like $300,000 in retirement. So I tried to say to Mike, well, active should get more competitive then. Either they're going to do better because there's more passive ownership and more active opportunity, or they're going to lower fees to the point where they beat their benchmarks
but you
more
can't
often.
Lower fees beyond the operational burden of researching and generating alpha.
Gravy in these companies is so ginormous. I mean, Fidelity makes $18 billion a year. That's like four Vanguards.
That's the problem.
And they have a fourth of the assets.
Yeah. Well, we didn't talk about this earlier, but
I mean, that's fine. It's a capitalist society. I'm just saying that it's capitalism that's also the reason for this. People who have a choice, and even if they agree with your point, they're going to buy that cheap index fund that's 4 bips because that's their kids' retirement, college, their retirement. And until you change those hearts and minds, it won't even matter. It's almost like an academic conversation.
No, we totally agree. I think Mike's thesis is, and I think I'm aligned in to a great extent, is there's no mechanism through incentives where this dynamic can change. In fact, all the incentives are likely to accelerate this dynamic. But there is a point at which the trend is unsustainable, and it's like it's Stein's law. If something can't go on forever, it will stop. Right.
So the only thing can I push back on that just a little bit, which is, and again, if you remove the Fed from this conversation, I think I would agree with you more. I think the problem with this conversation is the Fed, because index funds, I don't think they would be able to, their flows would be able to overwhelm that dog food scenario that we talked about. Totally. They might provide some bids a little bit, but they're not overwhelming that. So I think, if you really start to unpeel the layers of the onion, you end up at the Fed and not letting the market just behave normally, and let prices settle down. And that's why you end up having this beta vortex, I think, because it's just easier to buy the market or something close to it. And also the demand side is also always let off the hook here. That's why I brought it back to the retiree person. And the other thing is people, advisors in particular, I try to challenge them on this. I'm like, you keep buying stuff. Like if they buy a value ETF, they'll tend to buy VTV, which is like not value. I mean, it's almost looks like
it's
the
98% beta, 2% value.
I mean, it's we call it watered down, right?
Yeah.
So they keep buying watered down stuff when they should go and buy something that's different, because when the market turns, they'll have that there. It's like a soccer field. You don't always go where the ball is. You want to have, but they don't do it. And so whether you're an institution or an advisor or retail, they keep following the ball and they keep buying things that look like beta. And I think the Fed is the sort of, I don't know what the word is, like the fueling that or making it okay to do that. If you took the Fed out,
it's certainly fueling it.
More shake up more often, and you'd have assets spread out more, in my opinion.
The career risk of not participating in the S&P 500 right now is astronomical, right? So that's why you see these people prefer, oh yeah, I'm going to call it a value fund. I'm going to say that this line item is value, even though they likely know that it's pretty much the S&P, right? They'll have a little bit of tracking error, but not too much. And so, I think Natick is the one that said or pushes back in the Mike Green conversation that everything is not passive. In fact, you said that true passive is only 15%, I think, right?
35.
And the rest. Well,
Yeah,
I think
he got to 35
passive, and then SMAs, then plus.
No. If indexed,
which is what
40.
which is what.
Yeah,
like market cap indexing is what
so maybe half of
what
that
drives this theory that Mike Green has.
Right.
But if not everything is market cap indexing and people are actually taking their positions down because they're actively managing it, and therefore this cycle, this self-reinforcing cycle, doesn't actually come to fruition, then it's a problem. But having said that, we now have discussed the fact that a lot of these active managers are just doing the same thing as a market cap index because they can't. So it's just.
Yeah.
I don't think it like all these models try to be like at the
what you just
extremes,
said.
right? There's something in between, but I think we're leaning more towards everybody trying to be an index, but trying to be market cap because it's too scary not to for your career.
I would call that the beta. We call that the beta vortex.
That's the beta vortex, right?
And we think the Fed powers the beta vortex, and it's nobody's fault. Everybody's just acting. And you're right. The incentive system is you have to have it, because if you don't have it, we looked at this. If you're pure. And God bless the pure guys. We really try to give them a lot of love because they're walking a lonely road. But when the ball gets kicked to their side of the field, they crush. So that's why I sometimes say that like things like Deep or QVal could be the arcs of their day. Because when and if value comes back, they will be the shiny object in the room. But no one would have bought them ahead of time. They should. Instead of buying VTV, if you own SPY, you should buy the deep value one. That way, when a ball gets kicked there, you're good and you get that initial spark and it diversifies.
I tweeted about this today. I think there's an opportunity here for the deep value guys to finally have their decade of "I told you so." I think
Eric's point is if you're going to take an active bet, you want to actually take an active bet, not take
like
an
that
active
concentrated
bet.
value bet. That's why you make the Alpha Architects value ETF and what is it, 40, 50 positions. You don't see that in the large BlackRock value momentum ETFs.
But the thing is that's where the money goes, and so it's the demand side of the equation is definitely overlooked a lot in these conversations. But this is how consumers are shopping. I mean, they're buying, whether it's institutional or advisor, they're going to buy stuff that looks like beta, and that's why I think when Mike points out indexes, fine, maybe they're at the core of this, but I think it's a bigger beta vortex.
Okay. So now I'm tracking. I don't think I was tracking what you were saying.
But my point to him is that active is part of this. And ultimately, I think if you were able to somehow get the Fed and rewind time, in fact, I used to think that in March, the kitchen sink day was like Superman 1, where he rewound time by flying around planet Earth like at 1 million miles an hour. Because it literally, like, the market went right back to where it was. Like, it was like Superman. If you had not done that and you let the market get all jacked up and stuff disperse. I think some of this would have taken care of itself and been less of a worry. But because the Fed comes in and because it just means beta keeps working, there go. But I sometimes defend passive in that they're a variable in this whole mix. But you've got the Fed, you've got advisors who refuse to buy pure stuff. There's a lot of people who and you have that retiree I talked about who maybe they agree with you completely market structure, but when it comes to their kids' educational fund, they're going to go cheap beta. And when, like I said,
the Fed is fully aware of the wealth effect. They can't allow spending to dry up, and therefore they need to make sure that what people are using as expenditures, which is borrowing against their mortgage, borrowing against their stock, or using their actual stocks to survive in retirement, you can't have that go down. I mean, what was crazy about that V recovery, that vortex, I like that. The beta vortex, is that what you call it?
The beta vortex, yeah.
Remember when we had the what did we call our podcast where we were like, where is the market going to go? This is like
the pandemic portfolio.
The pandemic portfolio, right? We don't know, right? We don't, and we're like, let's create some narratives, and the narrative for a V recovery, is like, what if they come up with a vaccine tomorrow? What if like COVID goes away? What if everything gets better? We are going to see a VIX recovery. We were dead wrong about the narrative. We saw a VIX recovery and everything just got worse, right?
By the way,
that's how crazy that is. How much
create a narrative.
You know the Fed has that.
Did you ever heard that term, conversational alpha? This is what the theme guys talk about with advisors. They're like, our theme ETF, it gives you conversation alpha. So he's like, it's tax alpha. This is like, because you can talk to the client. Like,
they say this out loud.
Hold on, stop. Drill into this for me, Eric. Just go right down the rabbit hole in this conversational alpha. What do you mean by that?
Selling
conversation alpha is like, advisors are always looking ways to like get more engaged with their clients, right? So there's tax alpha because it's like, okay, I have these Vanguard funds here, but what are you doing different? Because I could go do that on my own. So it's all about like, making more value.
Protecting the 1%.
Yes. So conversation alpha is this, and somebody, I think Global X trademarked the term actually. And it's like things you can talk about with your client. Like, hey, there's this huge trend in cybersecurity. And they give you the numbers so you can discuss it with them. The fundamentals are here, and it's conversation alpha. I know this is to tell you guys.
We're in the podcast now.
So
we're in the podcast now.
Yeah. We see.
I know.
This
I'm sorry. I didn't make it up. I'm just the messenger.
It's brilliant.
We left that
on the message board. Dave Natick and Brian Portnoy are going crazy with this.
Well, the problem is it's like the truth is terrifying here.
Yeah,
right? We all know. Like,
it's a lot uglier than we want to admit.
Gartman did the same thing in the early 2000s or mid 2000s, right? Like everyone subscribed to the Gartman letter. And then Gartman informed all the conversations that advisors have with clients. And it's compelling storytelling, right? And it's absolutely conversational alpha. But I do think that there's this weird tension because
I can tell you guys are just like, your minds are blown. You don't even know.
I just love that I love that somebody TM'd this. Like, is there no?
It's not like it's a meme that naturally occurred. The marketing team was like, I got it. I got it.
But this is only for advisors. This conversational alpha can never leak to the end client. Right?
And that's why they're growing at 60% on average per year, man. That's what drives flows.
This is what you're
conversational alpha.
I hear you. No, I love it. I think it's great.
Well, BlackRock hired the chief marketing officer from BuzzFeed. So the big guys they're well aware you got to sort of speak.
Okay, well, we know. We're going to hire another quant next week. Now we know we got to change our strategy.
Exactly. Brian Portnoy just been his IP attorney. Here you guy. He's the guy who's getting ahead of the trend here.
That's right. My God. Okay.
I really think Eric's point earlier about the conversation, the problem with this conversation is all about the Fed. I mean, I think that's 99 of 100 answers to all of investment and finance questions today. It's Fed bashing, and I think what Rodrigo was saying about the wealth effect is a real problem because it's become the S&P is now the savings vehicle for the average American, And so they have no exit. They're cornered, and all they can do is keep doubling down and keep doubling down, which is why eventually the printing press is going to get taken away from them, either through inflation. And here we are back on global macro.
Blah.
Well, it could go on for a lot longer, for sure. But
we are going to die before this ends. I don't know.
Possibly. It's quite possible.
We might have blips here and there, but no, this ain't happening.
Well,
wait, hold on a second. What is aspirational utility? Eric, have you heard of this one?
No, but that seems from the same brain. I don't know. It's right up there.
We need vixologists on here to correct Ken Hebner and tell us what aspirational utility is.
Anyhow.
But like the point just made about the retirement, this is a good point Mike Green makes, and I never thought of it fully that way, but treating the stock market like the retirement of America, it does make it a much different scenario for the Fed. So that's where you get, I think, more empathy for the Fed. But
the wealth effect, right? The wheels of the economy come to a grind if everyone feels poor.
The problem is there's only half of people are in the stock market. So you're purposely rewarding only half the people. So you could argue on a bigger picture that that's not the best way to spend money. Let the stock market work itself out. It will give you 10% a year if you could hang in there. You should pay your dues with the risk, right? And then let's give the money to the economy in some other way.
Which is why fiscal is coming up as
that's
prominent tool.
Fiscal going, so the Fed acted, and it's very complicated. But all of this, I think, affects the passive conversation, and it's all like we woven together, and it's hard to undo one of them.
It's a multi-dimensional problem. Yeah. It is very hard to untangle.
Well, it is. I like the idea. Nadig says here that it's the social safety net. They're outsourcing the social safety net to the S&P. I tend to agree, right? Like what they should do, every American will probably appreciate this, is they should go and confiscate, like Peru is doing. They should confiscate all qualified accounts, take it in for the government, then spend it all, because they'll just write a check at the end of the year. They don't have to actually invest anything. And then the wealth effect doesn't matter. They just need to pay a certain check that they can devalue by inflation. That's the solution here, gentlemen. This is why no other country runs it this way. What is this qualified account nonsense?
A moment of silence for Rodrigo's capitalist libertarian roots.
It's what's happening to my country right now, man. Remember we talk about the superannuation funds that are independent? They're all being taken over.
For the death of your libertarian roots, man. I love it, but it's...
I just see they're only out.
Jump the shark.
There's that Sanford Bernstein argument, like passive is worse than Marxism. That's a whole nother level of like craziness, in my opinion, in that the passive only owns a section of the market. We've established that. But also your example of Peru, right, taking all the money and then just distributing it. What you do get in the stock market is the innovation of America. And I think that will never go away. It's just a matter of how much that gets, I guess, watered down by just Fed.
Well, there it is. We got the definition of what's it called again? Aspirational utility. It describes venture capital, private equity, Ark, and other shiny objects. The idea of Tesla is worth this much because we are going to solve the
problems of the world,
energy problem of the world.
I don't think that's quite what is implied there. I think what is implied is that every American has the opportunity to aspire to be Elon Musk. Right? It's not like at the aspiration of the commons. It's like the aspiration of the individual in order to be able to, to take on that.
Are you equating that to the pursuit of happiness?
No.
Is that,
it's exactly what Tesla
the pursuit of happiness?
Dreaming of rich. Exactly. Portnoy nailed it as usual. Distilled it to its true, features here. Right. So I don't think, let's not attribute everything to
let's give my thing another name. I'm sure there's something I can sell to the advisors. Somebody in the chat come up with something.
Exactly.
Yeah. Well, you actually made me think of it when you said what we were saying. We were discussing building a narrative.
Yeah.
Yeah, I mean, you're in the. It sounds like you're in the ballpark. You're not that far away from conversational alpha when you say that, right?
Oh, totally. But
No, 100%.
this is what we struggle with as quants all the time, right? Like, because the narrative of quant is the history of relationships between an X variable and a Y variable, which is really not very exciting, right? Whereas the narrative of thematic is, I really think solar is going to dominate because the cost of cells, the energy rooted cost of cells relative to the carbon equivalent is accelerating, and it will cross over the carbon equivalent by 2023. And at that point,
I think it's more dramatic and simpler.
And
Adam, it's about saving the world. It's about, there's too much pollution. If we don't move to clean energy, the world is doomed. We all have to go in this together. It's like
so
the
why
GameStop
isn't the
mentality
nuclear
worldwide.
ETF taking
Well,
all the
You want to talk
capital?
uranium?
Yeah.
Right,
Well,
yeah.
Yeah,
uranium
well,
is
look,
like
did you guys hear
the
the
most marginal
O'Shaughnessy
cost.
podcast with
Jeremy
Jeremy
Grantham?
Grantham? The
Yeah.
best 15 minutes were the last 15 minutes when he asked him, what are you excited about? And you hear these stories? The stories
What do you
about the
say?
battery that they can charge in 10 minutes and last twice as long, that are half the size. The plants that can sequester nitrogen from the air and double the amount that you can use for fertilization, the carbon credits and the sequestration. And indeed, he talks about clean energy as nuclear power plants and doing it better, right? So these stories were so captivating. I mean, even us as quants are not sitting there talking about the skew factor all day. We're talking about Bitcoin, right? So it's just, I get it. I chose the wrong career.
Well, the other thing on that is it used to be a portfolio manager would be responsible for keeping up with these themes. Okay, there's a new thing going on with nuclear energy. I'll add a little to that. This is just essentially outsourcing it to people so they can make up their own mind but they're all driven. There is fundamental stories in these themes. Typically, they're not, if you look at their fact sheet, or if you listen to one of them talk about themes, it sounds like a portfolio manager on Bloomberg TV talking about a specific area. Even the millennial ETF, which I was like, oh, this is ridiculous. But all it does, it's not a bad idea. It's like, let's invest in stocks that have over 50% of their customer base is millennials. Well, millennials are pretty tip of the spear when it comes to like new tech. It's not a bad way to sort of invest in the focus group of the early adopters of the consumer world. And it's done pretty well. But ultimately, again, a lot of this is rooted in growth. But I think the themes essentially outsource the active management to the people as opposed to the manager doing it. But what he was talking about reminds me, he almost probably just gave out 3 or 4 theme ETF ideas in that conversation. So they just take that idea and turn it into a whole fund.
But
So
the,
it's not-
the challenge is that the themes themselves, while interesting, if you're not anchoring them to the price you're paying for the companies that are channeling those themes, then you're not investing we all know that the most exciting themes are typically are very highly priced, and often they're like priced well above their intrinsic value. And so there's a reason why growth now, growth underperforms value is a nice trope, except that it actually hasn't been true for 30 years. But there's a reason why everyone sort of says, if you're excited about an idea, it's probably not a good investment because you're not the only ones who's excited, and excitement leads to higher valuations, and higher valuations leads to lower expected returns, right? So you don't want to get, we're in a narrative driven market right now where the story accelerates and amplifies the return, but
And
there's a mean
overpowers
reversion
everything
component
else.
of that.
Do you remember, I was thinking about like the idea of narrative and themes and how indeed value was, terrible by 98, 99 when the story was the internet, right? Value was taken out to the woodshed and nobody wanted anything. And of course, it finally came when growth crashed, value crushed it. But I don't recall anybody getting too excited about value. I do recall people getting excited about the BRICS, right? Brazil, Russia, India, China, the next story, the decoupling of the U.S. to the rest of the world. Like value doesn't even get a
No,
day
but
in the sun
value-
from a narrative perspective when it's doing well.
No, but
right? It's
value
overshadowed
is-
by the next exciting theme.
It's
next
so
momentum
highly
stuff.
correlated with the performance of ex-US versus US, right?
Sure,
Like
yeah.
US is basically a growth market, ex-US is a value market.
Mm-hmm.
So taking a position in emerging in EFI relative to US is a proxy value play.
I don't know if it was that or if it was like the inflationary aspect of BRIC countries and
It
commodities.
was
going through the
China
roof.
opening up to the world, binging on commodities, and then the
Yeah.
emerging markets.
It was a
were
completely different
benefiting
theme.
from that
Dude, I bought
tailwind.
into that theme too. I'm just saying that the value
I lived it in Brazil.
correlates with EFI and emerging. So it all ends up being sort of thematically analogous.
Sure.
So it's
I'll buy that. I'll buy
I mean,
that. That's
kinda
okay.
wanna-
They're playing with the names a lot, and like I said, there's a airlines, hotels, and cruise ships ETF. That's an interesting example. It's
ETF?
possible. Yeah, it's all in one name. It's it's the stuff. It's kind of a reopening trade, also. When everybody goes and starts partying again. But it's possible they start messing with the names of value, and you might find theme ETFs, things that suck, or Wes will refer to his own ETF as like dirtball stocks. It's possible that
Sink.
you could. It works, and people trust a little reverse marketing sometimes, or reverse psychology. It's like, at least you're being honest. I'll buy that. Or like bargain basement or something. It's possible value gets renamed in the next turnaround by all of the conversational alpha marketing people that have really popped up since this growth run. So they have yet to really try to relabel value. But I'm with you. The returns, though, were very nice for value. I mean, I was marveling at small cap value was up a ton in the 2000s, and the S&P was flat. And then if you go from the 2000 to today, small cap value is still winning. That's how amazing that was, and how much a downturn hurt the
from
S&P.
2000, right? Yeah.
Yeah, and so when and if value comes back, the returns will be sexy. Whether it even needs a label, I'm not sure. It will just be the shiny object in the room.
That's interesting. I have an idea for an ETF company. You launch a single product, a single ETF, and you call it whatever the theme is. Let's say in the beginning of the COVID, you call it vaccine or something, right? And your theme is just vaccine. And then but it's going to be like my favorite type of Netflix shows. I hate the Netflix shows that go on for 10 seasons that should have ended in season 2, right?
Right.
You don't want vaccine to last for 10 years, right? You want vaccine to last for about 18 months from the moment it came up. And then when it's over, you say, by the way, I'm going to change the ticker and the theme. You kind of redo the prospectus, and then you do, I don't know, whatever the next theme is going to be 18 months from now, inflation or, BRIC. You just literally say, this is your chameleon ETF, and I'm going to theme the crap out of it. I think that's going to be my next project.
Exactly.
I mean,
TM.
And plus, once it starts humming, people in it won't care as long as it's up. And sometimes they forget they bought it. We do find that when a theme ETF has a run, like the shiny object moment, let's say it gets $1 billion, and then it goes down a lot. I don't know, a third of the assets will stay, at least. Sometimes
That's
half
the
stays.
universal truth, dude. Like if you can collect the assets in the beginning, then you're set, because just a third of them will just forget they ever owned it because they don't want to actually look at the performance.
Or they don't want to crystallize their losses.
I'm blinded.
Yeah,
They don't want to crystallize their losses. Yeah.
Taxes too.
No, yeah, sure. But just ignoring it is a really good strategy for AUM.
But yeah, I mean, sometimes I'll look at some of these theme ETFs and I'm like, I cannot believe that thing has 500 million now. Like they really are collecting assets. So yeah, we just wrote a bit looking at this week, looking at how themes could be bigger than all GIC sectors combined. It could shake out over a growth sell-off, but what the themes also do is, besides stealing a little of the quant thunder, is they are sort of finding this real hole in the sectors. The sectors companies they go across too many sectors now. And so themes have, I think, taken some of the sector. They've stolen some of that thunder too. Mm-hmm. So I think in a way there's just this, they're disrupting a couple of systems that were embedded that weren't able to capture this stuff as well. And because they can go across the lines. But right now, the theme ETFs have 180 billion. That's bigger than any sector tech has 150 billion, and
Styles. How big are styles? Because at the end of the day, it just seems like themes are the closet, styles and momentum, and we should relabel momentum as a factor to narrative or something.
So themes blow away. Momentum is so underserved to the academic community respect to the assets. I've never seen a bigger ratio with momentum. Now growth is big, and I think growth probably steals some momentum assets. Growth has 200 billion, value has 200 billion. And then there's multi-factor has about 100 billion, and then low vol might be 50, and then momentum. I want to say it's all MTUM, by the way. It's like largely
that. Where does quality rank there?
Quality is probably going to be, I'm going to guess 70 billion. I mean, value and growth, it's still that legacy from, the 90s carrying over.
Morningstar style boxes. Yeah.
Yeah, I mean, that meant a lot, but I mean, low vol and dividend strategies. Eric, you guys think dividends a factor, or is that like just?
Dude, don't even.
Don't even go there. Okay, how about low vol? Is that a true factor, or is that lame?
Min vol is a portfolio construction technique that seems to have merit. Low vol is a concentrated sector bet in extremely low vol sectors. But
so low vol isn't a factor.
No.
So would you say value, momentum, size? Those three, we all agree. What about quality?
What is ask 10 quants and you'll get 10 definitions of quality.
It's so subjective, and I think it just is used as a cloaking mechanism for people to just own what's in vogue and not call it narrative or thematic.
What would you say dividend? When we have dividend ETFs, what factor loading would you say they are? Like what are they stealing from?
Well, it's a diluted value factor, but it's just it's people
defensive?
That don't understand Modigliani and Miller. Like, if you understand that you should be agnostic about the way that companies distribute their cash flows.
Exactly.
It's it really is a capital structure decision and not anything to do with expected returns. So dividends is not a thing.
Yeah, we have them in smart beta. We're very liberal with the tent, but I agree with you. When we have quants on, they'll definitely dividends don't get much respect. I mean, once in a while, if an MSCI person gets up at a conference, they will include dividend as the sixth factor they're looking at, but normally it's just the 5. But they do include low vol typically. But then when you talk to the real PhD type quants, they will just give you the 3 typically, and then quality, they, like you said, they might be like, and then that's it. But the one momentum of all we just talked about, all of them are healthy except momentum and quality, only 28 billion. And dividends have 225, and you just said they're not really real. So I think that's also speaks to your, things that come out that have a label that people can identify with. But
That's interesting that dividend doesn't have more. I remember the dividend achievers index is so intuitive for the average retail investor, right?
This is only ETFs. The mutual funds probably have a lot more. But ETF wise,
a Canadian ETF.
That's 3% of assets. It's pretty good. I mean, to put that in comparison, like ESG has 70 billion, so dividends have 3 times what ESG has. I mean, it's 225. Especially in the ETF world, it's very hard to get assets there. So 225 to me, I would call respectable. And then we have smart beta. Do you believe factors exist in fixed income?
Yeah, absolutely. There's definitely systematic factors.
You guys offer any strategies?
Actually, fixed income is the ultimate arbitrage because the construction of the benchmark is so flawed, right? Like who in their right mind would construct an index based on the amount of debt outstanding? Like,
every advisor?
I hear you, but it just is so silly when you say it out
the ag
loud.
is big. Yeah. I mean, I remember my first book, Josh Brown said, the ag is total bullshit. It was made up by a guy who tried to sell bonds. And it's amazing how the stories of some of these things that grow so big are like born in these really quirky stories, and it gets a universe around it. And then it's like, oh, he's doing it, I'll do it.
It's like buying miners based on the total square footage of tailing ponds or something. Like, what is your total environmental footprint? It's the strangest construction you could contrive, and yet this 80% of total global credit in fixed income is oriented in this direction. So it's a great opportunity to outperform.
Yeah, that's why bond managers, if they chose the right asset class, I mean, we always talk about how they were smart to pick that benchmark. That said, in March, only 5% of them or 10% of them beat the ag. When the ag is sucks until it doesn't. Because when treasuries are a safe haven, the ag will crush a lot of these active funds. They've cheated honestly, if the ag doesn't have high yield international, is it really fair that the active fund can use those?
No.
But they do. But they do.
Yeah, totally.
And so this is interesting to us because fixed income smart beta only has 40 billion total. And some of those funds are pretty good. Like at Wisdom Tree, they got ones that's like ag, but they like work in some extra yield there, or they'll do one that's like risk weighted instead of, which you guys can identify with, as opposed to just weighted by market cap. And they do
it's
pretty
the same
well.
thing for the commodity ETFs, right? I mean, there's
Same
just
thing with commodities. They'll change
just like
otherwise you're all
what's been out there.
Don't give Jeremy
recently.
Schwartz too much credit here. Just relax. Just
Aggie.
pump the brakes on.
Aggie, he likes Aggie's pretty big. You want to know how big Aggie is? What would you guess? Assets.
Oh man, I don't even
Can't
want to know. Do I
possibly
want to
guess.
know? My ego is gonna get hurt.
Okay.
No.
All right, tell me.
Fill us in.
Okay. Would you guess or no?
No.
Okay, 1.1 billion, which is respectable. It's 12 bips though. If you're under 20, you got a tailwind going.
True.
And it's the ag, which they're comfortable in that world. It's not taking any extra credit risk, but we think if there's a huge sell-off like March, but it goes on for 6 months, the beat rate of bond managers will go down so dramatically that it should open the door to the quant world more, because it's going to be very clear that, well, why are they all underperforming? Well, because they went into high yield international, which the index doesn't hold. And that's why the index is beating everybody, because it never did that. And it's going to the conservatism will look good. That said, they're active. They might be able to go right into it and navigate it quicker. But this is an interesting phenomenon and brings us back to the whole conversation with everything and the Fed. It is interesting that bonds and stocks have gone up so much together for so long. The everything up thing also, that worries me as well, because sometimes you have these sell-offs where everything goes down. And I remember it was in 2018.
Last couple of days, right?
Only cash was positive.
This is where I get confused when we talk about active. Our version of active is being able to short stuff, but that's been gone for decades, right? Because how do you survive in this world?
Is it even legal to short anymore?
I don't even know. I think it will be illegal.
Definitely
it should be. It should be.
Don't even tell people you lose your job. Yeah,
Exactly.
But I mean, is there the fact that we talk about active as if it's just picking long only stocks is just appalling at this point, and everybody talks about it that way. But active is supposed to be tactical. Go to zero. Go short. That's active. And I think when the tide goes out, we're going to recognize that, we should have had more active options out there. And hopefully, hopefully there'll be some more.
Let me say one thing on that, which is that there's a lot of, there's this provider named AIEQ or something, BTAL, CHEP, and they do long-short quant strategies.
Yep.
They do it the real way. I mean, this is even more hardcore than Wes. But, nobody cares. But when there's a sell-off, BTAL will be the top of the charts because they got the short position. And that's why a long sell-off, I think, will shift money around, where this whole passive blob thing will regulate a little on its own, because there'll be these things over here that have short positions or deep value, which will start to outperform the indexes potentially, and you'll see money shift over to them. But we talk about this idea of, we have these little case studies of when there's a sell-off, and the stuff that is true and pure shines. The problem is the sell-off never gets to last long enough or to have a regime change.
Yeah, nobody's been naked in a while.
I never knew you were such a Fed hater, dude. There's a brotherhood, man. We could
you need to come up. You need to come up and visit
clubs.
I wouldn't say
T-shirts apparently.
I'm not
for
full
you and your kids.
I'm not. I empathize with their position, though. I mean, you're gonna let everything it's almost like everything's too big to fail. I mean, it's almost like somebody said once, the buy side now is too big to fail, and they're gonna have to bail out PIMCO and Fidelity, and it just seems like, because what are they gonna let? Because that's where all the retirement money is.
Yeah, the Fed's going to fail the moment I give up on my shorts and my active stance. The moment like Resolve Asset Managers, like, that's it, we're done. Let's just throw in the towel. S&P 500 long with a slight tilt.
Well, you know that guy in
That's when it's
Philly
gonna-
where I live, Ted Orenson. He was done. He was like, he had a value shop, and he is starting something new, but he just closed up. He's like this. He goes, because even if it comes ripping back, he was like, the track record will still suck.
Yeah, exactly.
He did the forward prognosis and said, there's just no escape. It's pretty existential. It's not funny. I mean, that's a dark place to have to view from, but I would blame the Fed if I was to me, I would point the finger at the Fed in that case, because it never let the sell-off happen enough where you could have the glamour stock sell off and then value looks good, and they never let that play out.
Mm-hmm.
Okay, well, look, there's an hour 45 minutes. I've now realized that we're kindred spirits, and until we can physically hug,
Can you give me one of those? I have a 10-year-old and a 4-year-old, so can you hook me up with the? It's each.
He's got all the sizes, man.
Absolutely.
He's got all the sizes.
I've also got the I am John Galt hookup too, if you'd like those.
Listen,
shirts.
man, he'll be the envy of the flag football team.
Exactly.
Yeah.
No doubt. Like, who's the Fed? What are you talking about, dude?
Yeah, I mean, he plays in South Philly.
You want to talk about some privileged, wear for your children when you're wearing like a
If you
Fed
put
t-shirt
ETF on a
at 8?
shirt, people think it's like T-Mobile's eliminate transfer fees. So there are
it's a
some
win-win.
alternatives. Yeah, but
Everyone interprets it in the winning scenario for their context, right? Yeah, that's perfect. I love
Eric,
it.
the Fed.
honestly, this has been really fun. This is one of my favorite riffs. A true
I
riffing
agree.
back and forth.
Totally,
It's
it's been
great.
a lot of fun.
Wide-ranging.
Always
funny.
enjoy our chats, man.
Yeah.
Likewise,
Hopefully, we'll be hiking next time we get, or we can, if any luck, we can also chat over cocktails. But those hikes are
Pennsylvania,
also fun.
Pennsylvania in August.
I want to come down there and I want to go on a fishing trip.
Dude,
Dude,
we're
I'll
gonna
do
go
Oahu.
fishing. We're
That
gonna
would be
go.
amazing.
We're gonna catch a fish
Adam
festival.
just fished Oahu last week.
You missed
That's
it.
a massive
We chatted about that.
Yeah, I mean, I went down there about 3 years ago because there's enough terminals, and a lot of the wealth managers down there will use ETFs in the U.S. So there was enough for a whole day or two of meetings, and it was funny walking around the streets. I'm like, how many trillions of dollars am I around right now? Because like all the U.S. corporations have like all this money sitting there, and you're just like, you can almost feel it. It's like this building
the
probably has a
electricity
trillion.
of zeros and ones
Totally.
emanating from the computer centers.
Absolutely.
Indeed.
But anyway, thank you for inviting me on. It was fun.
Where are you going for dinner?
We're going to a place called Le Viet. It's a Americanized Vietnamese restaurant.
Right
With
on.
a couple with kids, so we have a babysitter. So it's we haven't been out in a while, to be honest, and we certainly haven't been on a double date kind of hangout situation probably since the pandemic. We've gone out for steak dinner a couple times, like just the two of us, but this is going to be fun. And
I'm going out dancing with Corey Hofstein tonight. Believe it or not.
It's just
you
Rodrigo
really?
and Corey Hofstein dancing.
No.
Swear to God.
Okay, hold on a second. Where are you physically? You're in LA?
We're in the Cayman Islands.
He just moved down
He's
here
in
for a
Cayman
while.
right now? No.
He is in Cayman. Yeah, he
Oh,
came
he's
into the concierge program. Yeah, he came in last week. 2 weeks of quarantine. Him and his wife, taking him out dancing with my wife. I got babysitters. I started drinking 2 hours ago, so I'm gonna keep it going.
Oh, you're going to be in rare
It's gonna
form.
be a ton of fun. Yeah, there's just before anybody judges me about dancing, there's absolutely zero COVID here. There's no mask wearing. This is a tiny island that they locked down, so there's
You should live cast it on Twitter so we
there
can
is-
all
Rodrigo can
There's
dance too. Let's be clear. Like,
absolutely
this guy can
zero
absolutely
COVID.
dance.
People, please don't judge. We are gonna go and get sweaty and dance with a bunch of people. It's gonna be fantastic.
That sounds so good, man.
And
That's
I'll
like-
take all the pictures of Corey dancing just to see. I can't even imagine it. But his wife said Boogie Nights and said that Corey was coming. And I said I'm in, and I'm bringing 2 cameras.
And are you going for like a straight club with like techno, or more of like a bar where they play like, rock songs and you dance?
No. This is a legit like lights. It's Boogie Night theme, so 60s, 70s, and 80s.
Okay. Okay, so it's
And
not
a
hard
massive
house.
draw.
It's not like Jungle House or something. Okay.
No,
It's literally
no.
like my 20s at university.
Yeah.
Like
I tried to get Butler to come, but he apparently says he's not willing to get that drunk
I can't
tonight.
get drunk enough at this age to function over the weekend with my family, to have fun on a Friday night dancing to Pearl Jam.
Pearl Jam? That's
can't.
what your mind went to? Let me disabuse you.
Where
There will
else
be no
is
Pearl
90s?
It's
Is
boogie
it like
nights.
I saw the sign?
Yeah,
Like what is
Woogie,
it? Like,
woogie, woogie.
like-
I don't know. Anything with it.
Staying Alive.
Cotton
Staying
Eye
alive.
Joe.
Donna
Yes.
Summer. They're gonna play all the stuff that makes you think
course.
like it's 8 a.m. and I need to go to sleep. Kind of like those
1 in the
disco
morning.
songs that
But
you
I've been
hear
up for 3 hours too long.
at
It's
the end
going to be
of the
fantastic.
night.
You can still change your mind. You've already started with me. We started together.
I've already killed like a good quarter of this bottle of
Same here, man.
Zacapa. I started with a good quarter of a bottle.
That was my plan all along.
All right.
I'll come pick you up at 7.
7 a.m. I'm in. Enjoy your Vietnamese, Eric. Thank you so much
Yes,
for all
Eric,
the
that
great
was
energy
great.
and
Yeah,
insight. This has been a lot of fun.
Enjoy the
Yeah,
dance and
likewise,
take lots
guys.
of
This
pictures,
was
Rod.
it's fun talking this. It's fun like going off the ETF reservation a little bit. But yeah, and keep in touch, and I'll hopefully wherever you guys are in. Are you guys come to Philly at all?
Well, we come to March.
We'll
at the
come
very
to the
least.
March, yeah,
And,
the
we
March of
would
the
come for
Fallen.
other reasons too.
That's right. That's a Philly-ish event. Yeah. So I'll probably see you there.
Yeah.
Okay.
Although I got ribbed for staying at the hotel.
Well deserved.
That's right. No,
Jeremy
Adam
Shore.
got the couch last time, didn't he?
Me and Jeremy stayed at the hotel, and we never heard the end of it. But it was. I think it was worth it. I'm a late
The Big Bear? Did the Big Bear hug you? All right.
Anyway,
Love
all
it,
right, guys.
Love you guys.
Yep.
Have a good weekend.
Enjoy your
See ya.
Vietnamese.
All right.
See you.
Today's podcast is brought to you by Horizon's Resolve Adaptive Asset Allocation ETF, which trades on the Toronto Stock Exchange under the ticker symbol HRAA and is sub-advised by Resolve Asset Management. HRAA is an alternative fund whose investment objective is to seek long-term capital appreciation by investing, directly or indirectly, in major global asset classes, including, but not limited to, equity indices, fixed income indices, interest rates, commodities, and currencies. HRAA gains exposure to these asset classes by investing in derivative instruments that may include future contracts and forward agreements and securities. HRAA will take long or short positions, using up to a maximum of 3 times leverage in asset classes such as equity indices and fixed income asset classes, commodities, currencies, volatility indices, and other alternative asset classes. To learn more about this, please visit www.horizonsetfs.com/HRAA to read about the ETF's investment objectives and important disclaimers about the risks associated with an investment in the ETF.